3 major stocks at 52-week lows. They're selling at their lows, which is a great way to screen for value plays. But the question is, are they low enough? Microsoft, NVIDIA, Taiwan Semiconductor. Let's do our 8 pillars and figure out where they are right now. So Microsoft, 8 pillars, right to it. Well, actually, first off, high of 350, low of 225, currently at 228. 8 pillars tab, what I love to see. Checks all the way around except for valuation. Now, why do I like this so much? Because to me, this says, hey, this is probably a pretty good company financially. But here, the market's putting its value maybe a little too high. Now, just because the valuation, the metric is high, doesn't mean it's overpriced. If they have major growth potential, it could wipe that all away. But it's a big company. Market cap's 1.7 trillion. The revenue, more importantly, is 200 billion. It's hard to grow a $200 billion company. Let's see what analysts thinks. Analysts are looking for $9.50 this year in profit in the last year, and going to $20 per share by June of 2007. Now remember, 47 analysts in part of our data feed, and it drops down to 14 by the end. So less and less analysts are looking at it. Let's look at revenue potential. Still double-digit growth, $200 billion to 380. And again, 48 analysts down to 16. So still double-digit growth here. I'm going to use a 10-year analysis, as you guys all know, on our stock analyzer tool to go do revenue growth. So I'm going to go with 4, 7, and 10. Profit margin, they have higher profit margin now because of subscription base and their cloud computing. So I'm going to go 29, 31, and 33. And I like to do it for companies like this, having the same free cash flow margin. Okay. PE. Mo, what are you going to put in for PE for Microsoft? This is where I like going to you on, because it's kind of hard to determine what PE and price of free cash flow to use for such large companies.
Maybe 13, 15, and 17.
Okay.
So those assumptions on the low side, I think they're pretty low.
I agree.
So they're very modish. Everyone uses Microsoft.
Yeah.
Let's try it. 13, 15, 17.
Okay. I'm going to put that in there. My personal opinion would have been 14, 15, 16.
Okay.
But this is part of the art of investing. Everyone's going to have a disagreement. Warren Buffett and Charlie Munger always say that if you ask each of us individually, what's the intrinsic value for Berkshire, we're going to come up with different numbers. But overall, if we do a lot of companies, we'll probably end up with similar numbers. Yep. Desired return. Microsoft's a big company. I'm going to do 12, 13, and 14.
That sounds good. I put 12 and a half, 13 and a half, 14 and a half.
Hit the analyze button. 228 is the current price. A low of 100, a high of 175, a middle price of 130. And if you look at our other Microsoft videos, they're going to be all over the place because we make our changes all the time. But the point is, you're not going to see 280 and 150. You're going to see a variation of 10 or 15%. Yep. The point is, when it comes to overvaluation, you don't know the exact point it's overvalued, but you sit there, you can see very quickly if you look at something and say, that's overvalued or that's not. Right. Here, I see it saying this is overvalued. So I'm going to be more patient. I have it in my watch list at 170 to notify me when it hits there, to do more research and decide what to pay for it then. Yep. Mo, NVIDIA.
NVIDIA, this is the one that everybody loves. This was the darling. Guys, this was almost $350 a share, and we're currently sitting at 117. This thing has gotten to a low of 113. So the stock that everybody said could not go down is now down. But again, let's look at it. Overvaluation. 5-year PE of about 58, 5-year price to free cash flow of 59. Shares outstanding, dilution a little bit. I'm not terribly surprised by that. Let's actually just go see what it is. Maybe, it's not terrible. That doesn't worry me for a company like this. But let's see what analysts have to say about this one. So revenue growth, they see it basically doubling into 2027. So 5 years out. And I'm sorry, that was earnings per share. Revenue growth, mid-teens. Around those mid-teens, so it's actually kind of consistent with Microsoft. Let's run it through Stock Analyzer. Guys, I know that this company is going to, just based on this PE of being, 5-year PE of being around 59, did I say? 58. Current PE, 37. It's going to have to keep falling, but it's falling into our range. Revenue growth. Let's see. So I'm going 10 years out, not 5 years out. I'm going to put on the high side 12. Mid, I'll go 9, and 6 on the low end. 6 maybe a little bit low. Profit margin, Paul, what do you think?
So profit margin,
like 26 is that level.
Oh yeah, actually, I'm actually surprised it didn't have a bigger profit margin last year.
Same. I thought it would spike.
For me personally, I would do like maybe 23, 25, and 27. And the reason being is if there's chip demand shortage, they might have to decrease margin in order to spur some things on. So I'd probably be more conservative for such a high stock like this.
Now PE currently sitting at 38. What are you thinking?
I think
big company. I don't know.
I think 13, 15, 17 here as well. Maybe 14, 15, 16, but something along those lines.
Let's go 14, 15, 16. And same for price to free cash flow?
Yeah, of course. You know me. I like to have them be the exact same thing.
And return. What are you thinking here?
12.5, 14, and 15.5.
Okay.
Because to me, the 12% is going to be a lot harder, even though the chip industry has a lot of growth potential. 12% compounded annual growth rate over the next 10 years, according to a report I read recently. It's still like, for those numbers to really hit, I just feel like it's the higher the desired return, we got to put that margin of safety in higher.
Okay. Current price, $117.50. Let's see what it comes out to. Anywhere from $41 to about $65. So that makes a lot of sense. I actually have it on my watch list at 55. I'm going to increase that. I'm going to put it about 75, 80, somewhere in there, just so when it hits that number, I start paying more attention to it.
And we can sell puts on them. So that's one thing this channel, as you guys know, does great, is selling puts to buy shares at lower price or being paid to wait for a company that we want the price you want.
Just threw it in at 80.
Final company.
Taiwan Semiconductors.
Taiwan Semiconductor. TSM. Boom. 52-week high of 145, low of 62. Today, it's down another 5.5%. And keep in mind, the tech industry is up right now today, I think. I think the Nasdaq's now up. So this is quite different here, but it's down quite a bit. And if I told you that back in January, when the stock was at 145, that this company would be less than half in 9 months, you've been like, you're crazy, Paul. If you don't believe me, go watch our last videos. You'll see that. So let's go to the 8 pillars tab. Oh, wow. So here's a big disconnect here.
That's the thing I don't like.
Why is the PE and the free cash flow so different? With a higher free cash flow than PE, it's saying that there's less free cash flow. Less free cash flow. We can sit there and go here to our cash flow statement. The average over the last 5 years, 8.8 billion. The average in the last 5 years of income, 15.34. So they're reporting a lot more income than free cash flow. And I wonder why.
What's with that free cash flow doubling? Actually, it's doubled multiple years in a row.
Yeah, that's very interesting.
Basically went from 4 to 8 to almost 16.
And look at this. Here's an interesting part. Well, they had big capital expenditure. Oh, wow. They really increased their capital expenditures here, Mo. 28 billion last year.
Wow.
So guys, they're investing in the future, it seems. That's why their free cash flow and earnings are so different. When you spend on capital expenditures, it doesn't get depreciated on the balance sheet immediately. Sorry, on the income statement immediately. It takes the useful life. It could be 5, 7, 10, 15 years, whatever it is. So this explains to me why their free cash flow is lower. So I'm kind of okay with that, but you got to make sure that if this stock falls into your range, you do research on that to verify that. All right, let's see what analysts are saying about Taiwan Semiconductor. $37.50 for this year, up to $54 by 2026. So not huge growth, about 50% growth total. And then revenue, another about 50% growth total. No more than that, 60 or 70%. All right, with ample 38 people covering it, 20 in the later years. All right, let's go to Stock Analyzer tool. I'm going to go very low on revenue growth rate.
Okay.
I'm going to go 2, 4, and 6% because that's what they're looking at in terms of the analysts. Profit margin, I'm going to go 32, 34, 36.
Okay.
Free cash flow. So this is where it's hard because the free cash flow.
Do you go with, yeah.
Because it's so much lower because of capital expenditures, so we'll even out a little bit. I might be more aggressive on free cash flow here. I might do 24, 26, and 28. But I want to make sure that if the stock falls to where I want it to be, I verify that the capital expenditures are going to taper down, or if they're going to keep doing the capital expenditures, are they investing in the right areas for the capital expenditures? Because guys, this is where a business, if they're not deploying their capital in highly efficient ways, as an example, a very easy one, you have a house. If you put $10,000 in your kitchen and you only get $5,000 out of it when you sell it, that is not a good use of funds. You are getting a loss on your investment. If you invest $10,000 in your kitchen and you get $20,000 in value, you would do that all day. If you're in an apartment building and you can do that and you do it every single unit. That's the point here. If they're not spending their money on capital expenditures to get higher rates of return, then that's not a good thing.
Something I don't like here, I just noticed, they're paying 2.6% dividend, $8.75 billion. Their 5-year price to free cash flow is $8.8 billion.
Oof, okay, so another thing.
Yeah, I just caught that.
That's a risk to their free cash flow.
Yeah.
To their dividend, I mean. They're paying out, in the last 5 years, they're paying out basically 100%. If they replicate the last 5 years again, 100%. Now, the benefit is, last year they did $15.7 billion in free cash flow.
Exactly.
So it's still over 50%. We like to see that number under 50% of the 5-year free cash flow number. We want the dividends paid to be less than 50% of the 5-year free cash flow average. Okay, so it's definitely above that. That would say that there might be a risk to the dividend. All right, PE. The current PE is 14 because they had a bigger year. So I'm still going to go with 14, 15, and 16. And same with the price of free cash flow. Desired return, 12, 13.5, and 15.
I like that.
Hit the analyze button. Boom. Oh, we're actually not far away on the top side. Low side, we have 30 to 40. High side, 45 to 55. Mid side of 35 to 50. So here, I'm going to add it to my watch list at $55. Because even though it's not worth that to me, it allows me to go in there and either sell puts on it or decide what the stock's going to be worth, or both. So obviously, this is a great video. You need to watch the next one on how to find and analyze value stocks. Thank you very much for your time.